Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi everyone, this is Yazad. Equity markets have been very erratic in the past few months, and the weak market sentiment has driven both the Sensex and Nifty down over 7% in 2022. Quantitative tightening, rising crude oil prices, and inflation have dampened investor sentiment. In the absence of a significant event, there has been a furious struggle raging between bulls and bears. Amid all this volatility, many stocks have hit their 52-week lows, irrespective of their fundamentals. While it is not always prudent to buy stocks just because they are close to their 52-week lows, it is worth looking at stocks of well-known, high-quality companies that are leaders in their industries and have stood the test of time. In today's video, we are going to look at 5 such fundamentally solid companies that have strong business models and impressive track records of returns for investors. Risk-tolerant investors could add these stocks to their watch list, as these stocks could help them by providing diversification and provide some stability during these turbulent market conditions. First on the list is UltraTech Cement. Shares of the company are trading at their 52-week lows after it recently announced a 129 billion rupees capex plan. The company plans to add 22.6 million tons of capacity to cater to future growth. However, analysts believe that in times of weak demand and high fuel costs, any significant capacity announcement is a negative. Input costs have remained elevated for the past few months, and cement companies haven't been able to pass on the cost increase. Further, capex could impact margins. But UltraTech Cement has a strong balance sheet to ensure this planned expansion without stress. The net debt to equity ratio of the company stands at a low of just 0.2. After this expansion is completed, UltraTech's pan-India market share will be close to 21%, with a 13 to 15% share in the south and east, 22% in the north, and 35% in the central and western regions. When it comes to debt levels, some analysts believe the company will be debt-free by the end of the financial year 2024, whereas others believe that the capex plans could delay UltraTech's ability to go net cash positive to 2026. The stock is currently trading at levels close to 5,500, which is a far cry from its yearly high of 8,267 rupees. Second on the list is ICICI Lombard General Insurance. The share price of the company hit a 52-week low on concerns of COVID-led claims. The stock is also trading at its lowest level since May 2020, as it has consistently reported weak results for the last 2 years. In the recent quarterly results, the company reported a 9.5% year-on-year drop in net profit at 3.1 billion rupees due to a decline in COVID-19 cases. That apart, underwriting losses of the insurer also widened in the quarter to 3.1 billion rupees from 910 million a year ago. However, weak results may just be a temporary phenomenon. The company is a natural beneficiary of pickup in non-life insurance space given huge underpenetration. It is India's second largest non-life insurance player and one of the largest within the private sector. The company also has 81% of its investments currently in debt, which means there is a scope for higher realized returns with a turn in the interest rate cycle. From its peak of 1,674 rupees, the stock has been hammered down almost 35% and is currently trading at its yearly lows of just 1,100. Shares of Shree Cement also hit their 52-week low as cement stocks came under pressure after UltraTech Cement announced its expansion plans. UltraTech's capex plans are likely to trigger a race towards maintaining or increasing capacity share. It is also expected to increase competition along with the possibility of price wars. The Adani Group has indicated that it may seek to double the capacities of ACC and Ambuja over the next 5 years. Shree Cement has also stated plans to double capacity. The company has set aside 90 billion rupees for its expansion plans. Shree Cement aims to achieve a capacity of 80 million tons by 2030, a 7% CAGR from 43 million tons in March 2021, indicating that its goal of doubling the capacity in 5 to 7 years is progressing at a slower pace than its earlier guidance. But experts are questioning if its balance sheet has what it takes to withstand the aggressive capital outflow. Shree Cement's debt-to-equity ratio stands at 0.1. It also has healthy cash reserves, which it plans to use to fund its capex. June quarter earnings of Shree Cement were a mixed bag. While realizations were better than expected, increased operating cost was a dampener, offsetting benefits of improved realizations. With volume growth at 39% year-on-year, Shree Cement lagged behind peers in the June quarter, with UltraTech Cement, Ambuja Cement and ACC delivering 47%, 53% and 44% respectively. The stock is currently available at just under 20,000 rupees per share. Yes, 20,000 for one share, but it's still much lower than its yearly high of 31,441 rupees. Next up, we have HPCL. The company's shares have been trading lower as crude oil prices have soared in the last couple of months. The price of crude oil recently topped $120 a barrel after Saudi Arabia raised the July official selling price for its crude to Asia by $2.1 from June to a $6.5 premium, the highest since May. Now, this does not bode well for oil companies such as HPCL, as it could further put pressure on margins. For the March 2022 quarter, HPCL reported a 40% year-on-year decline in net profit due to a decline in marketing margins. The company's revenue increased only marginally, while it earned $12.4 on turning every barrel of crude oil, as against $8.1 per barrel in the year-ago period. These gains were wiped away by losses on petrol, diesel and domestic LPG sales. HPCL expects crude prices to remain elevated throughout the year. However, the company hasn't faced any shortage of refined products and is able to meet requirements at its retail outlets using the refineries it solely operates or jointly owns. It also has high financial flexibility, supported by its parent ONGC that owns a 54.9% stake in the company. Last on our list is Grasim Industries. The stock has been in a free fall ever since it announced its plan to invest 100 billion rupees over the next 3 years for entering into the paints business. For this massive capital expenditure, Grasim Industries is planning to raise up to 20 billion rupees through debentures. Not only that, but Grasim Industries also happens to be the holding company of UltraTech Cement. Now, as we saw earlier, UltraTech Cement has also announced a new capital expenditure plan of 129 billion rupees to take on the competition in their sector. Now, this could negatively impact the company's financial health. As indicated by the results of the financial year 2022, the company's debt-to-equity ratio stands at 1. It stood at 0.25 years ago. However, Grasim Industries is the flagship company of the Aditya Birla Group, and it ranks among India's largest private sector companies. The company's core businesses comprise of viscose staple fiber, caustic soda, specialty chemicals, rayon-grade wool pulp, with plants at multiple locations. It also has other businesses such as fertilizers, textiles, etc. Has the market got it wrong? Only time will tell. In the meantime, for someone looking at a blue chip stock which is down over 30% in the last 5 months, look no further. Grasim is trading at 1,328 rupees, which is significantly lower than its high of 1,939 in January 2022. When it comes to stock selection, it is very important to have a margin of safety. However, at a time like this, when volatility is at its peak, it's better not to catch a falling knife. It means don't buy stocks that are falling just as you wouldn't catch a falling knife. Let the volatility settle until you decide to buy. So before you choose an investment, ensure that you dig deeper. Even the bluest of blue chips don't offer much upside if bought just before a massive fall. Investing in stocks anyway comes with inherent risks. Doing thorough research won't eliminate them, but it will surely minimize them. That's all we have for this week. Thank you very much for watching. Happy investing. Goodbye.